Welcome in, folks. It is the three-piece here today in this video. 3 videos for me to react to. First one up here, Cathie Wood. I fast-forwarded past the Bitcoin part. If you want to hear the Bitcoin part, you can go watch the original video. But I want to hear her outlook on her stocks, the markets in general, things like that. I want to react to that, kind of give my opinions and perspectives based upon that. So we're going to react to that one. Then I want to get into this one. The market is poised to go higher before year end. And hear what she has to say in regards to that, kind of share my perspectives and opinions about the market here into year end and how I think it's going to perform. And the last video up here is the economy has proven it can live with 4.5 to 5% bond yields, Ed Yardeni says. So we're going to hear what he has to say, and I want to share my opinions and perspectives on that one. Appreciate everybody joining me as always. Just so you guys know, I did let the main channel know I do have a Twitch channel now. It's called Yardeni Makes Money. I signed an exclusive contract with them to do live streaming, so I'll be going live on there probably in the next hour or two on Twitch. I'll put that as like pinned comment if you want to join me on there. It's Monday through Thursday I do that show. Alrighty guys, let's get into this.
ARK Innovation Funds up 20% this year. You're outperforming the S&P, but you've had significant outflows this year. Can you talk about that? You know, you're outperforming and yet you're having outflows. Tell us a little bit about what impact, for example, higher rates are having on your holdings this year. That seems to be a major issue.
Well, I think there are a couple of things going on. If you'll remember, in late 20 and early 21, the flows were enormous into our funds, and I was uncomfortable at the time because we thought there was a lot of momentum chasing going on, and we said at that time, keep some powder dry. Little did we know how big the correction would be. This is sort of the flip side of that. We're feeling much more comfortable right now. But we did have, through July, a very significant rally. I do think there's been some profit taking there. And I do think, as you say, interest rates, rising rates have concerned a lot of people. There's been a shift into cash, and we've seen very recently a shift into bonds. And interestingly, the flows into bonds would suggest that we should not be far behind, because if bonds are going to rally, and we think they will at some point here, as inflation continues to come down, as the economy continues to go through rolling recessions of sorts, we think that the backdrop will be right for a resurgence in growth stocks generally, and in particular, long-duration innovation growth assets like ours.
Okay, interesting. Now, first off, ARK has a major problem, to be honest, because you're talking about outflows of money, right? And the problem with ARK is it's been now known as something a lot of traders want to play. So if they're feeling like, hey, we're about to go risk on in this market over the next few days, few weeks, few months, right? Play ARK. And so, you know, it started out as like this long-term thought process of like, oh, we're thinking about 5 years out and all this stuff. But now a lot of traders are just using ARK as basically a trading vehicle of almost like a call option or put option on the markets in general, right? Well, really, if they're betting on the downside, they're playing more SARK, or is it TARK? I can't remember which one it is, the negative ETF in regards to Cathie Wood's ARK fund there. But that's what's going on now. And so it creates this kind of dilemma where you're attracting, I think, a lot of more shorter term folks that are going to be kind of playing the market from a shorter term perspective and just using ARK as a vehicle to basically do that.
Colleague Scott's got a question here. Scott?
Hi.
Hi, Cathie. Great to have you back on the halftime report. So given what you just said, do you not believe in higher for longer?
I don't, and we don't, I should say. If we're paying attention to company earnings, and some of these are companies we're exposed to, others not, you'll see at both the high end and the low end of the consumer spectrum in terms of price points. You've got Domino's saying, hey, it's really weak out there. We've got to do more promotional activity. And you've got LVMH, same thing. Both of those happened last week. We're paying attention to company reports, and I understand.
For LVMH, I mean, I don't know if they necessarily say it's really weak out there. Their growth was still 9% in the quarter, right? So it's definitely a deceleration of growth for LVMH, but it's not like, oh my gosh, this is the end of the world. Like 9% revenue growth is impressive. You're in trouble when your revenues are going down.
The economic statistics are volatile and showing strength and then weakness. We're
true.
paying attention to our companies, and it does seem like the consumer is starting to give way here.
Interesting. Okay.
Yeah, interesting. Let me ask you about a specific stock that you sold, and that's Nvidia. Do you regret selling it? You called it, quote, really expensive. I will note that the forward PE of Nvidia is literally half of Tesla's forward PE. So how can Nvidia be really expensive with Tesla not being so? And do you regret selling it?
Okay, Scott, that right there is a freaking great question. Great job, Scott. That's the type of question we need, okay? That's higher level stuff. That's freaking good stuff, okay? Anybody that's a little higher in the market in terms of level of intelligence, you're going to enjoy a question like that. That's freaking good stuff. I can't wait to hear how Cathie Wood tries to justify this. This should be interesting.
We own it in our specialized funds. We've taken it down everywhere. And this is portfolio management. We see Nvidia. You might say it is less expensive than Tesla. We think the upside surprises on Tesla during the next 5 years, and remember we have a 5-year investment time horizon, are going to be substantially more than Nvidia's, mostly because most analysts do not believe that autonomous as a taxi platform for Tesla is going to be a part of the story. We disagree. And with that, we see incredible revenue and margin expansion. NVIDIA's margins are already quite high, having entered the 70s, the gross margins. Tesla's are in the 20s, and we think they will scale into the 60s and 70s as autonomous takes off. So Tesla, we believe, is the biggest
I'll be honest, as a Tesla shareholder, I wish that was true, but I'm not buying that.
Project or autonomous driving is the biggest AI project in the world. Nvidia has been critical to providing the infrastructure to enable this and so many other things to happen. All praises to Nvidia. We think that a lot of people understand how important Nvidia is in this ecosystem, and they do not understand how much each dollar of hardware spent is going to pull software through. We think it's on the order of 20.
Why I believe she's a little, to be quite frank, crazy in regards to thinking that Tesla's margins going to 60, 70% is, at the end of the day, when we talk about the autonomous taxi network opportunity, long term, that's going to be commoditized. You know, maybe Tesla has an advantage at first, but long term, that will be commoditized. It's just going to be commonplace for vehicles to be able to drive themselves long term, right? And so you won't be able to command those sorts of margins long term because it's going to be a competitive space. There's going to be other people that are, you know, basically going to be undercutting price, and Tesla's going to have to react to that and all those sorts of things. So, you know, is it possible Tesla could be first mover in the market? I think 100%. But longer term, you got to understand when the market gets to a new stage, you're likely going to be lower margin. And then as time ticks on, it becomes more commoditized, and you'll be into, you know, good margins, but like, you know, there's a whole different set of circumstances. You need to have 60, 70% type margins. You know, Nvidia can have that because they're so far ahead of everybody in regards to that, right? But even Nvidia won't be able to command those sorts of margins long term on their chips unless they continually keep that advantage. And for Tesla, when it comes to autonomous taxi opportunity, there's no place better you can really take that, right? It's the vehicle drives you from point A to point B, it makes it there safely, and that's that. So it's not like you can take it to the next level and next level. It's just, it needs to get there and get there safely, and that's it.
Times. So we think Nvidia is going to be a good stock. We think the stocks in our portfolio, and we've written a paper on artificial intelligence. It's titled "Investing in Artificial Intelligence: Where Will Equity Values Surface?" You can read that on ARK-funds.com and see how we're a really good diversification into this AI world. Many think that the winners are going to be the megatech companies who have had such strong performance over the years. We are not sure. We are not sure. ChatGPT could be the best thing that ever happened to Google, and that it lit a fire under Google to get its own AI into the market more profoundly. Or it could be the worst thing in that it's going to lose its advertising franchise if we're all just on ChatGPT looking for our answers.
All right, Cathie, thank you very much.
Okay, true, Cathie Wood, but guess what? I have news for you, Miss Cathie Wood. That would be huge for Microsoft, which is another massive big tech company, right? So, you know, I don't know about that.
Much more with Cathie Wood coming up on ETF Edge at 1:10 p.m.
Okay, so bottom line is, in regards to that, you know, she definitely tried to slither her way out of that whole Nvidia situation, but no doubt she must regret selling Nvidia stock. And at the end of the day, Nvidia is the most direct AI play, you know, certainly in the world, right? It's the most direct. And I own several companies that should benefit from AI over time, Palantir being one of those, right? Tesla being one of those, right? I own several stocks, Meta being one of those, that are going to benefit from AI when it comes to it's a new business opportunity for them, or it's going to, you know, in Meta's circumstance, they might not make money directly from AI, but it's going to help them push better ads, right? Command better ad dollars, be able to put, you know, even potentially better ads together for customers over time, right? By using their AI platform. So there's a lot that can happen there, and it's exciting, no doubt about it. But yeah, Nvidia is the most direct play in the world, certainly on AI. And so, you know, it's I don't understand why she wouldn't own it, given her investing, you know, prowess in strategy. It just makes sense that would be one she owns. All right, next one up here. The market is poised to go higher before year end.
Across the board, Rob, I thought these guys set it up perfectly. I think it really boils down to a simple question. Are we set up for a year-end rally or not? I think that's what our viewers want to know more than anything else. How would you answer that question?
I think it's possible. It's certainly possible. It's a seasonally strong period. We're in an environment where there's a tug of war between high interest rates, geopolitical tensions, valuations that are high, and an economy that is strong. Earnings are delivering, and a consumer that's remaining resilient. And so I certainly think that that's a possible outcome. Now, let's remember, if we were to rally back to those July highs, valuation becomes an issue again, especially if it's driven by the stocks that have the Magnificent Seven, and rates have stayed higher. You have those same tensions at that point. When we look over the last 2 years, Scott, markets haven't gone anywhere. When we look...
That's true. Markets haven't gone anywhere in 2 years. That's factual information. But before we go any further here, I want to push back against his point he just made there about valuation is going to become an issue again if we push up to, you know, back to where we were several months ago, right? I could definitely disagree with that. Look at a company like Pepsi's earnings, okay? Pepsi's earnings were absolutely freaking phenomenal. And so Pepsi's technically a cheaper, much cheaper stock today, not just because the stock price come down over the last few months, but it's a much cheaper stock today than it was previously because earnings are in a lot better place than I think a lot of folks anticipated. So if you have these companies come in, the Metas and the Amazons and the Googles and these sorts of companies come in and report phenomenal growth in that bottom line especially, you're not going to have any valuation concerns, really, even if we push the market higher because the earnings are there to justify it, right? So that's where we get really interesting into this whole game of like the market could go up, but the market could technically get cheaper even if the indexes rise just for the simple fact that earnings come in really good. Now, if earnings came in trash and all these big dog companies report horrible earnings, the Nvidias and the Metas and the Googles and you know, Apple, Microsoft, Amazon, all these companies, then you definitely do have a valuation issue, right? But, you know, many of those companies I think are going to report incredibly, we know Nvidia's in the bag. It's going to be ridiculous net income growth year over year. Meta's in the bag. Is going to be ridiculous net income and EPS growth year over year. Google should be pretty strong. Amazon should be ridiculous. So you start going through those stocks and it's like a lot of them will either kind of be flattish or very, very strong growth in the bottom line.
Markets have not gone anywhere. And yet what we're seeing is a lot of opportunity underneath the surface because of the narrowness of these stocks. So I think the answer is yes. I think you have to be a lot more selective.
Okay, so Shan, 11% of the S&P 500 reporting this week. Netflix and Tesla, those are obviously going to be critical. Yields are up a little bit today. I feel like the the tug of war really exists between the bulls and the bears on the yield front in some respects. Yes, we're up a little bit today, but there still is, at least according to the bulls, the idea of this dovish Fed pivot. You had Goolsbee today from the Chicago Fed said, quote, undeniable that a slowdown in inflation is now the trend. The bear case, of course, they don't care about this alleged Fed pivot or not. They're like, well, yields are still going to remain high, and the lag effects of tightening are yet to come. Which side do you fall on?
Well, I think this short-term oscillation that we talked about last week, and Scott, we're going to get plenty of ammo from the Fed this week. We've got a lot of people out speaking. We've got Powell here in New York on Thursday. And so I think, this bull-bear tension is really about what are we talking about? Are we talking about the rest of this year? And I agree with Rob. We certainly could be setting up for the potential for a higher equity market from, between now and the end of the year. But the longer term lags of these rates, it continues to be the open question coming into 24. And how does that impact the consumer in particular? I think the other thing that you touched on is, what's happening from an exogenous perspective on the rate market right now. We were worried about U.S. debt.
Before we go any further here, let's take a peek at stocks. I know it's a green day out there, but I just want to see how green are we really talking, and why is my stock watch list all messed up? Am I not even logged in on TradingView? What is this? What is this? I don't even think I'm logged in on TradingView, folks. Holy smokes. Wow. Anyways, we were going to look at a ton of stocks, but for whatever reason, TradingView not quite working. You know what? Let me log in, and then we'll go from there. Alrighty, folks, I got my TradingView logged in. Okay, so here we go. Well, Fubo is making a huge move up today, 7%, so definitely more of a risk-on day. Avant's making a pretty big day, up over 6% Avant today. Revolve's up over 5%. Foot Locker's making a big move. Cheesecake Factory's making a pretty nice move. Shopify, Texas Roadhouse, Amazon. PayPal's even moving up. Holy smokes, that's no joke, folks. Let's check out big tech here today. Oh, Apple's the only Red Dead Redemption out there in big tech land. Literally everything else is green. Meta's having a really good day. Where's Tesla at here? Tesla's having a decent day, so that means the public account is likely looking really, really good today. So interesting, very interesting. Okay, let's jump back into this.
And we were seeing the yields were ticking up higher and higher and higher, and really didn't seem like much of a floor or a ceiling, over the last few weeks. Then we have what's obviously happened in the Middle East. You're seeing a little bit of a bid come back into the market. There could also be some additional positioning, Scott, coming into the end of the year in terms of people needing to bolster their fixed income exposure to ahead of December 31st. And so you could get a little bit of additional incremental Treasury demand. All of that, though, is inconsistent with our view of 2024, which is going to be a more challenging environment and more dispersion underneath the surface. Couldn't agree with Rob more on that particular point. There are going to be winners and losers next year in the equity market. And unlike this year, where we had a very small contingent that were leading the returns, we do expect there to be more stocks that show sort of those idiosyncratic forces in a more challenging environment.
Josh, I want to focus really on the next 2.5 months before we even sort of turn our attention to 2024, because, we've had a good year in the major averages. Under the surface, obviously, the performance of non-mega cap tech hasn't been nearly as great or carried through as much as those stocks have done.
JB?
How do you see it between now and the end of the year? 2.5 months. Are we now set up for some kind of, significant move higher?
So I think that we are, and I would tell you that, and I don't mean to start the show off disagreeing with Rob, but I don't see valuations being the problem, even if we do get back to the old highs that he sees them as. The Russell 2000 has a PE ratio of like 12 times forward earnings. The mid caps are like 13. The stocks are not expensive. The phenomenon of the Magnificent Seven is really what's making the market, like when we say the market looks like valuation might be an issue solely because of the massive outperformance and the proportion of the indices that these stocks take up. They're up huge, and they're a huge component.
Okay, so that was interesting. Now, how do I think stocks are going to do into year end? Okay. So, I feel pretty confident about the next month, but I actually don't feel as confident for like the whole Santa Claus rally. And the reason I don't is obviously you still got this thing, everything going on in the Middle East, and that's gonna, we'll see where all that shakes out, right? But I think you're gonna have a lot of tax loss harvesting going into kind of, let's call it, back half of November and into December. A lot of these dividend stocks, value stocks have done horrible. I think there's going to be a lot of tax loss harvesting on those stocks. There's probably already been some, but I think there's going to be a lot more coming. And I think that could weigh on a lot of those stocks specifically. I think there could potentially be some profit taking if big tech has another big run here. Let's say, big tech's looking pretty good for earnings season. So let's say, the stocks like the Metas and the Amazons and, the Googles, Apples, Microsofts, Nvidia. So let's say stocks like that make another big run over the next 30 trading days. I think there's a potential some profit taking going into 24 and people kind of worrying about, valuation again if the stocks climb, right? And also potentially worrying about the economy in 24 and where the market's going to trend. So yeah, I would say I'm a little more confident in the shorter term, like less, let's call it 30 days and less. Not as confident actually for the whole Santa Claus rally setup.
Is picking up steam this week with more than 50 S&P 500 companies and 5 Dow components set to report results. Joining us right now is Ed Yardeni, he's the president of Yardeni Research. How are you setting yourself up this morning, or maybe even I should have said last week, ahead of everything we've already started to hear on Friday?
Well, to tell you the truth, after hearing that report that you we all just heard from the Middle East, things look just basically horrible over there. Yet, the market's hanging in there pretty well, and I think that's because we've had several of these crises and conflicts between Israel and Hamas that led to ceasefires pretty quickly. This one looks like it's going to linger. And yet the price of oil hasn't really shot up. But I'm accentuating the positives here in terms of what the market's focusing on. And that's, as you said, it's earnings. I think it's very likely that when all the earnings come in, that the third quarter is going to be at an all-time record high for S&P 500 earnings, which is pretty impressive all in all, since the Godot recession, the most widely anticipated recession of all time, just has been a no-show so far.
So, Ed, though, think about how do you think about those earnings? And I know it's just impossible to put these things together with what's happening in the Middle East and what you think the larger geopolitical implications are, and therefore for the broader market. So we could have amazing earnings, but it's not even just what's happening now. Obviously, stock prices are looking out, call it 12 months, 18 months out. Where are we then? And how does this situation factor in? Recognizing, interestingly, at least from the academic studies that I've seen, and just, you look at charts over the years, with the exception of what was taking place in Israel in 1973, for the most part, when there have been problems in the Middle East, they have not impacted the stock market as negatively as you might imagine they would.
Correct. Well, I think the obvious example of when the Middle East really did have a tremendous impact on the global economy and certainly on the stock market was back in the 70s when we had 2 energy shocks in 1973, and that was related to a war between Israel and the Arab states. And then in 1979, when the Iran Revolution occurred, oil prices soared a lot more than they've increased so far since the summer.
Sure.
And as a result, I think the market is looking over the next 12 months and concluding that this too shall pass. One way or another, the situation will be stabilized. And if that's the case, then the outlook for 2024 is probably pretty good.
Okay, but here's the thing, prior to a week and a half ago, where was it a different debate about not whether things, putting what was happening in Israel aside, because it hadn't happened yet. There was just a fundamental debate about whether we were headed towards a recession, how deep the recession would be, and whether, frankly, 2024 or 2025 actually wasn't that it was going to be positive or stable, it was going to be bad. I mean, that was, I think there was a lot of people that were concerned about that.
Sure. Well, look, one of these days a recession is going to happen. The business cycle hasn't been, forever banned. And I do think that the outlook for now is pretty good. I mean, the economy has proven to be remarkably resilient. It's true that we've seen this tremendous increase in short-term rates and the bond yield, and yet the consumer continues to spend. There's still a lot of fiscal policy stimulus in the pipelines. Companies are investing in artificial intelligence.
You know what I think's actually going on here, folks? I believe that if the market's green, people start feeling better. A lot of these Wall Streeters start feeling better about the economy and what's going on. And when the market's red, they start suddenly feeling bad, and all the consumers getting hit. And this is, I just feel like so much of the sentiment is is basically being determined by if the market's red or green. And if you get a few red days in a row, all of a sudden everybody thinks it's the end of the world. Oh my gosh, everybody starts looking at everything from a negative lens. And when the market's green, everybody starts looking optimistic. It's crazy, man. But it's actually the indexes that are driving sentiment and not people driving sentiment, which is very intriguing.
So on. And as you know, we had a really strong GDP during the third quarter, which is why earnings are probably going to be at a record high. So I think the economy has proven that it can actually live with 4.5% to 5% bond yields. Obviously, if we go a lot higher than that, Jamie Dimon of JP Morgan has been saying, these are extremely dangerous times, and yet his bank reported tremendous upside surprise earnings in the third quarter.
Yeah, exactly. That's where things get kind of funky in this market, right? You got somebody warning about that, but yet his earnings are freaking phenomenal. So this is where we get in a very intriguing market, folks, and I appreciate you being here. As always, thank you for being here. Thank you for being subscribed. I appreciate y'all. If you want to join me over on Twitch, go ahead and check out pin comment down there. You can join me on there. You can follow me on there. Subscribe to me on there. And we'll be live very shortly. Much love and have a great day.